Ever wonder why some people seem to slip into real estate investing with pocket change while you're still saving for that elusive down payment? The secret isn't a trust fund or a miraculous windfall, it's an FHA loan, and it's been hiding in plain sight this whole time. Now imagine you're standing at the threshold of your first investment property. You've got dreams of rental income, appreciation, and building generational wealth. But there's one tiny problem. Your bank account is laughing at you. Here's the question that keeps would-be investors up at night. How do you break into real estate when conventional loans demand 20 to 25% down? That's where FHA loans waltz in like they own the place, promising as little as 3.5% down. Let's break down what's actually happening here. An FHA loan backed by the Federal Housing Administration since 1934 was designed to help regular folks buy homes without emptying their life savings. And yes, that down payment difference is as dramatic as it sounds. Picture this, a $200,000 property. With a conventional investment loan, you're looking at dropping $40,000 to $50,000 up front. With an FHA loan, suddenly you only need $7,000, give or take. But wait, before you start doing cartwheels, there's a catch. Actually, there are several catches, and they're wearing disguises. First off, FHA loans come with their own special brand of fees. There's an upfront mortgage insurance premium of 1.75% of your loan amount. Then there's the monthly mortgage insurance premium that sticks around like an unwanted house guest. Here's where it gets interesting. And by interesting, I mean slightly complicated. FHA loans require you to live in the property as your primary residence for at least 1 year. So much for that purely hands-off investment strategy you were dreaming about. But let's say you're smart about this. You buy a multifamily property, a duplex, triplex, or fourplex. You live in one unit while renting out the others, a strategy called house hacking that makes financial gurus shed tears of joy. Suddenly, you're living somewhere while your tenants cover most or all of your mortgage. It's like having roommates, except they're in separate units and you're building equity simultaneously. The math starts looking pretty attractive. Of course, there's always someone ready to rain on your parade. Critics will point out that after that mandatory 1-year residency, you can't just immediately repeat the FHA trick. You get one FHA loan at a time, making it a gateway drug rather than an infinite money glitch. Yet here's what the skeptics miss. That first property becomes your launch pad. After a year, you can move out, keep it as a rental, and potentially refinance or leverage your equity for the next deal. The game just evolved. And let's talk about what you're really saving. That massive reduction in upfront cash isn't just about having more money in your checking account today. It's about liquidity, flexibility, and having reserves for unexpected repairs when your tenant's toilet decides to explode at midnight. The real estate investment world has this inside joke. Your first property is the hardest. After that, you've got equity, experience, and a track record. FHA loans essentially hack that first property barrier. But the industry won't advertise this pathway loudly because conventional wisdom says real estate investing requires serious capital. Meanwhile, savvy investors have been using FHA loans as stepping stones for decades, quietly building portfolios while everyone else saves for that impossible down payment. Fast forward to today, and the strategy remains surprisingly relevant. Despite market changes, economic shifts, and endless predictions of housing doom, the fundamental math of FHA loans continues to offer that same powerful advantage for newcomers. Here's the twist nobody mentions in those glossy investment seminars. Combining lower upfront costs with strategic property selection can accelerate your timeline by years. Literally years of waiting and saving, just erased. Some will argue you're paying more over time with those insurance premiums. And they're technically correct, the best kind of correct. But they're missing the forest for the trees, because opportunity cost is a real thing. What's the cost of waiting another 3 to 5 years to save a conventional down payment while property values climb and rental markets tighten? Often, it's far more expensive than those FHA fees you're wringing your hands about. The adaptation game is strong here too. Investors have evolved the house hacking strategy into an art form, maximizing rental income while minimizing their own housing costs, all while the FHA loan does its heavy lifting in the background. And despite countless articles declaring various real estate strategies dead or obsolete, this approach persists. Why? because the math doesn't lie. And 3.5% down will always beat 25% down when you're starting from zero. So, does an FHA loan really lower your upfront cash need for real estate investing? Absolutely, dramatically, and almost absurdly so. But it's not a magic wand. It's a tool that works brilliantly when wielded correctly. The game is simple. Use the FHA advantage to get in the door. Play by the residency rules. Maximize your property's income potential and build from there. That's how empires start. Not with massive capital, but with strategic leverage. Ready to find your first investment property and put this strategy into action? Head over to www.growthsense.com, where we've built a directory designed specifically to help investors like you discover real estate opportunities that actually make sense. Because the best time to start was yesterday, but today works too.